Choosing the right stock order type can determine whether you make or lose money in the stock market. I remember the first time I ever bought a stock. I think it was Apple. I can't really remember, so it doesn't really matter. But the point is, when I logged into my stock brokerage, I went to find the stock, found it, had the option to buy or sell. I clicked buy, and then it asked me what order type I wanted to place. And this confused me because I thought the order type I wanted to place was a buy order. What I didn't know is that when you are investing in stocks, there are market orders, limit orders, stop limit orders, trailing stop orders, and I had no idea what any of these meant. I didn't know if it was important which one I chose or if I could just choose any of them as long as I was buying. So, like you may have just done, I did a quick search on Google to figure out what these order types meant. And thankfully for me and for you guys, they're not too complicated. I'm gonna do my best to explain them here in today's video so that by the end of this video, you know which order type is the right one for you. So one of the things that can be a little bit confusing to understand when you're first investing in stocks is that trades don't happen instantaneously. The moment you place an order, it doesn't necessarily get fulfilled in that instant. We've come a long way, obviously, from having to hop on the phone with a stockbroker, place an order with them, they go out, execute the order for us, call us back, let us know that our trade's been executed. We don't have to deal with all that now. We can do everything digitally, which is a lot more convenient, but the process that's going on behind the scenes is essentially still the same. But let's say, for example, you want to buy 2 shares of a stock. If you want to buy 2 shares of that stock, you go onto your computer, find the stock, you press buy, and you choose your order type, but we're going to get into that later. So you press buy. What happens after that is that your computer is going to take that order, it goes out into the marketplace, and it says, hey guys, my client has 2 shares of this stock that he wants to sell. Is there anyone out there who wants to buy these 2 shares? For your 2 shares to be sold, for that order to go through, someone else somewhere out there in the world has to go on their computer and place an order to buy 2 shares of that stock. Their computer is going to go out into that same marketplace and say, hey guys, my client's looking to buy 2 shares of this stock. Your computers are going to find each other, they're going to match up, they're going to be like, hey, this is perfect. My client has 2 shares, your client wants 2 shares, let's go ahead and execute this trade. So they're going to make the trade, and then they're going to give you a call, or in this case, an automated email saying that your order has been placed. So essentially doing exactly what a stockbroker would do. For larger stocks with more liquidity and demand, these trades are going to happen really quickly. They'll almost feel instantaneous. Like you'll place the order and a couple seconds or a couple minutes later, you're going to get an email that says your order's been executed. But for a smaller stock with less demand, there's less people out there looking for whatever trade you're trying to make. It might take longer. It might take a few minutes, hours, or even days, depending on the order you place. That's really important to know. It's the reason why some of these order types exist, and it's going to influence which order type you pick. The first order type is a market order. This is the simplest order of all of them. Essentially, when you place a market order, you're telling your stockbroker that you want to buy this stock or sell it immediately at the best available price. When you're looking at a stock, this right here is the market price. When you place a market order, your computer goes out just like in that example, and it tries to find a match for you at the best available price immediately. But just because the price is at this level right now doesn't mean that it won't change in the time you place the order to the time your computer finds you a match. So in that in-between time where your computer's out in the marketplace and it's saying, hey, my client has this order that they want to place, they want to buy, they want to sell, whatever. In the time it takes them to find another computer to match up with and make that trade, the price might go up or down. So just because this is the price in the moment doesn't mean that it will necessarily be that when your order executes. It might be slightly higher or lower. In the case of a larger stock, it's not going to be significantly different. It might be exactly the price that's shown here because it's going to execute the order relatively quickly, but for a smaller stock, the price could fluctuate significantly depending on what's going on in the market. A limit order is a bit more specific than a market order. When you place a limit order, you're telling your broker that you only want a stock at or better than whatever price you're specifying. So if you're placing a buy limit order, you're telling your stockbroker, I only want to buy this stock at or below my limit price that I'm setting. If you're placing a sell limit order, you're placing an order that you only want to sell at or above whatever your limit price is. and this is going to ensure that you get the price that you want. Let's say, for example, you want to buy a stock and the stock is trading at $110 currently. You think the stock is only worth it if you can buy it for $100, so you go in and you place a buy limit order for $100 for this stock. Now that order is not going to execute right away because the stock isn't trading at $100, it's trading at $110. Your order is only going to execute if that stock drops to your limit order of $100. So over the next couple of days, maybe the stock trades sideways, maybe it goes up, but then eventually it comes down below 100. As soon as it hits 100, your order is going to execute and you're going to purchase that stock. But just because you want the stock at $100 doesn't mean the stock has to come down to $100. So in that same example, the stock could continue trading sideways a little bit, continue going up, but then never come back down to $100. So placing a limit order does allow you more control over the price that you are purchasing a stock at or selling a stock at, but it doesn't necessarily guarantee that your order will execute. If the stock price never hits your limit, you're never going to have that stock execute. A stop order, also known as a stop loss order, is an order designed to limit an investor's losses or lock in profits. When you place a stop order, you're telling your broker that you only want to buy or sell a stock at a certain price, known as the stop price. Once the stop price is reached, your order is going to be executed as a market order for the best available price immediately. Let's say, for example, you own a stock that's worth $100. If you want to limit your losses to $10, you'll set a stop order to sell the stock if it hits $90. So as that stock continues to trade, maybe it goes up for a little while, eventually it might crash. If it crashes below 90, your stop order is going to execute. It's going to turn into a market order as soon as it hits that level, and it's going to execute immediately. So for the best available price, same as the market order, it might be slightly higher or slightly lower than $90, but it's going to execute a market order immediately and protect you from losing more than $10. A stop limit order is going to be very similar to a stop order, but in this case, you're going to place both a stop price and a limit price. So instead of your stop order turning into a market order and executing immediately, with a stop limit order, as soon as your stock hits the stop price, your order is going to turn into a limit order and it's only going to execute at or better than whatever limit price you set. Let's say in this example, you own that same $100 stock from our last example, and you have that same stop price at $90. In a stop limit order, you also need to set a limit price. So your stop price is at $90, you want to make sure you're getting out of the stock at $90. Just because you want to get out at $90 doesn't mean your order will execute at $90. So placing a limit order is going to give you a little added layer of protection. So you can place a limit order at $85. And this is going to mean that as the stock is trading and it hits your stop price at $90, you're only going to sell it at or above $85, which obviously, if there's a lot of people in the market who are trying to buy the stock, it'll sell pretty quickly and you'll get a good price for it. And you might get close to or exactly $90, but that's not certain. The stock could crash really quickly, shoot right through 90, go all the way down to 70. In that case, having a limit order will protect you from having your order execute at $70, or you can set your limit level for $85. And this will mean that you're only going to sell that stock at or better than $85. So if the stock shoots down right through 90 all the way to 70 and then rebounds back up immediately to 88, your order is going to place at 88 as opposed to placing down at 70 if you had placed a stop order, which may have executed down at this low level. Because remember, when we place a stop order, it turns into a market order as soon as it hits your stop price, and it's going to execute as soon as possible. So if as soon as possible is down to 70, you're going to sell for 70. But if you place a limit order, it will execute at or better than whatever your limit price is. So it adds some protection, but the stock might never rebound to that 85 level. In that case, you're stuck holding on to a stock that is tanking. Trailing stop order is our last order type that we're going to go over today. It's a dynamic order type, so it's going to automatically move as the stock's price moves up and down. So you set a stop order at a trailing percentage or amount. I'm going to show an example, it'll make more sense in a bit, but you set that stop order at a percentage or amount below or above your stock price. As the stock price moves in your favor, that trailing stop continues to move at the percentage or amount above or below the stock. But if your stock reverses direction by the trailing amount, it's going to hit that stop and it's going to turn into a market order and execute immediately. Let's say, for example, you own that same stock that's $100, and in this case, you're going to set a 10% trailing stop order. So in this case, 10% of 100 is $10. Your trailing stop order is going to be $10 below that $100 because that's 10%, right? As that stock continues to go up, let's say in this case it does really well, it goes all the way up to $200, your trailing stop order is going to continue to be 10% below the stock's value. So by the time it gets up to $200, instead of it being at $90 like it was in the beginning, it's going to rise all the way up to $180, which is 10% below 200. If that stock hits 200 and then it goes down and it hits that 180 stop price, that's going to turn into a market order and it's going to execute immediately at the best available price. So now you know what all these stock order types are, but which one makes the most sense for you to use. Market orders are going to be the simplest and most likely the best option for the average person. If you're investing for the long term, if you're buying larger stocks, ETFs, market orders are going to make the most sense. They're the least fuss. You don't need to know anything about the markets. It's going to get you the best available price right away. So for most people, this is what I would recommend. However, if you are a trader and you are keeping up with the markets every day, you're really involved in everything that's going on, you're tracking stock prices, and you are making trades on a shorter time period, maybe you're day trading, maybe you're swing trading over weeks or months, it will make more sense for you to utilize these other order types because you're going to be able to lock in more specific prices and make sure you are limiting losses and gains in what may be more risky investments. So that's where these other order types really come into play. They're going to give you a bit more control, but for the average person who's investing for the long term, it's just extra work. So there you have it. Now you know more than enough to go place the correct order type. Good luck with your investing. I hope you make a shit ton of money. If you liked the video, please like the video. If you have any questions, comments, concerns, drop them down in the comments below. If you have any feedback too, I'm a new YouTube channel, so I'd really appreciate any feedback you have. And subscribe for more personal finance videos like this. Peace.